metal in dollars. And the last thing I'll say, and this sort of extended answer to your question, is at the end of the day, while we measure precious metals in dollars or pounds or yuan, at the end of the day, with Basel III elevating gold to a high quality liquid asset on par with cash and bank stock at the central banks, really eventually we're going to measure everything in gold. And that's why the central banks have been buying so much gold. And when they flip that switch to CBDCs, they're going to reset the gold price in the US and around the world to capitalize those CBDCs as the new currencies and to allow them to write off all the old debts.
Robert Kientz's analysis of the silver market paints a striking picture of a system quietly building pressure beneath the surface. He believes that silver is showing all the classic signs of structural imbalance, a market where physical demand is steadily rising while actual supply remains dangerously tight. According to him, the problem isn't just about prices or trading patterns, it's about physical availability. Industrial sectors that depend on silver, such as electronics, solar energy, and medical technology, are consuming more of it than ever before. Yet global mining output isn't keeping pace. Silver isn't mined primarily for its own sake, it's often a byproduct of other metals like copper or zinc, which means increasing supply isn't easy. This sets the stage for what Kientz calls a quiet crisis, where silver's role as both an industrial metal and a monetary asset creates an inevitable collision between two worlds competing for the same limited resource. Kientz also focuses heavily on the widening gap between the paper and physical silver markets. He argues that futures contracts and exchange-traded products have created an illusion of abundant supply that doesn't exist in the real world. In his view, the derivatives market has become disconnected from the physical metal it's supposed to represent. Paper silver can be created with the stroke of a keyboard, but real silver must be mined, refined, and delivered, a process that takes time, energy, and capital. When too many paper promises are made on a limited physical base, a breaking point eventually arrives. Kientz warns that this imbalance could result in a sudden revaluation of silver once investors demand physical delivery that the system cannot provide. The moment that happens, prices would need to adjust drastically to reflect real scarcity rather than paper speculation. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
You find out that 4 big banks hold most of the short positions in the precious metals, specifically gold and silver. And those are Bank of America, HSBC, Citigroup, and one other I'm losing off the top of my head, but I'll remember it. So those 4 banks have done that for a long time. And so they not only hold them for their house accounts, they hold them for customers, and we don't know who those customers are. I suspect a lot of those customers are sovereigns. And so as you look at the meetings that are going on around the world with Trump and other people, Trump and Xi Jinping, for example, in China, Trump and the Japanese prime minister, which you just had, and also Trump and the resource deal they did with Australia, there's a lot of expectation that gold and silver prices don't need to rise too high because of those deals. And if you look at the traders, when you have this extended any sort of extended downward move or upward move like we've had in gold and silver the last year and a half, traders will want to reset their positions for the next futures contract. So all in all, a lot of this is just repositioning until the end of the year. And some of it is repositioning given what's going on in the markets with regard to trade. Now, also, we have Fed meetings going on yesterday and today, which are going to dictate whether the Fed lowers interest rates again. They just did at their last meeting. I believe it was a quarter point. They may lower it again this year because in the Fed's eyes, inflation's come down a little bit. And even though the job situation is not great, it's not enough concern that they would want to raise interest rates. They would want to lower them to spur the economy just a little bit because they're concerned about jobs. And so because inflation is lower than it was, say, 2 years ago, the Fed's expected to continue to cut interest rates a little bit to avoid what would be an official recession in the government's eyes. Kind of take all of those factors into account. It was time for gold basically to cool off a bit. The long-term trend certainly is higher, but I'm not sure that the world is ready for a much, much higher gold price because it points to the issues with the fiat currencies. Now, the central banks of the world have been de-dollarizing, meaning for the first time this year, that the amount of dollars held in foreign accounts is less than 50% of the total of global currencies held. which is a de facto way of saying, or it's a way of saying that the de facto dollar standard as a world reserve currency is over. So as countries are dollarizing, there's some sensitivity to what that does to treasury markets and the treasuries that foreign countries hold. So it's kind of like they're navigating the de-dollarization as these other powers, the BRICS powers and other nations, begin to build up their own currencies. So nobody really wants us to run too fast, too hard from a sovereign perspective, because it overexposes all currencies. Because if the dollar has trouble, you know that the Chinese yuan's going to have trouble, the pesos are going to have trouble, the yen is going to have trouble, and so on and so forth. So they're trying to navigate the de-dollarization and the eventual lead into CBDCs. So all of those are different factors in it. But at its most basic level is that traders are looking at all these things and they're saying, we had this big run up in gold. We need to reset positions. The banks want to reset and short cover because they had massive short positions. And this is basically essentially how a lot of the big banks also make money and their clients make money. If you go back to that fine that the CFTC levied on JP Morgan a few years ago, $920 million US for admitting to manipulating the treasury and silver markets, is they do manipulate the markets on a short-term basis to make money. And it came out, the JP Morgan said, for example, that they make $1 billion a year on these types of trades. It's big business. So they're willing to take the fine in order to continue that trade. So in the short term, this can be very damaging to precious metals investors, and it can be very frustrating. But one thing that I wanted to point out, if you look at the longer term, gold has been in a 25-year bull market. Silver, not quite 25 years, but it's starting to follow as its younger brother. And silver has a little bit more explosive upside because it's used more industrially. So we're actually running shortages from what the mines are producing to what we actually have. So I think the silver situation is going to come to a head faster than the gold situation. But the good news is, over the last 25 years, gold has followed very closely the CPI index over that period of time. Now, most of us don't believe that CPI is a real inflation rate, but the traders do pay attention. So even though I don't want people to panic, because even though we have all of these factors going on and it looks like gold has this $300-400 fall and silver has, $4 or $5, $6 fall in a very short period of time, a lot of that is just rebalancing. It's rebalancing, one, the futures trade and the OTC trade in London. Two, it's rebalancing the risk of London not having enough silver and the COMEX sending bars over to help bail them out. And three, it's rebalancing ahead of these trade deals and other deals that are going on in the economy. And four, the sovereigns don't want gold and silver to run too quick because they're not ready with the CBDCs. So what they're trying to do is manage that trade. And that's how I know a lot of the sovereigns are in using JP Morgan, Bank of America, HSBC, Citibank to do these trades. Under the cover of those banks to do it for them, because they're trying to manage movement into this new CBDC system. Now, if we look at CBDCs and digital IDs, they're probably going to be really ready for prime time in a couple of 3 years. They're being rolled out and tested right now. So I expect that this kind of shenanigans in the gold and silver market to continue by the sovereigns intervening in it, much like they intervene in the Forex markets and the treasury markets and the stock markets and the bond markets. They're going to continue to do that until the new system is ready. Now, I threw a whole bunch of stuff at you, but that's really kind of the calculus that you need to have when you look at these markets. And the one thing for precious metal stackers to understand, especially if you're new to this space and you're just learning, it's not dependent on the physical trade at your dealer or from APMEX or from Miles Franklin. It's really dependent on these derivative markets that sit on top of the precious metals. So just because the precious metal price comes down, you have to look at these other intervening factors more than you do what is the worth of your metal in dollars. And the last thing I'll say, and this sort of extended answer to your question, is at the end of the day, while we measure precious metals in dollars or pounds or yuan, at the end of the day, with Basel III elevating gold to a high-quality liquid asset on par with cash and bank stock at the central banks, really, eventually, we're going to measure everything in gold. And that's why the central banks have been buying so much gold. And when they flip that switch to CBDCs, they're going to reset the gold price in the U.S. and around the world to capitalize those CBDCs as the new currencies and to allow them to write off all the old debts. That's why Judy Shelton was on Twitter this week saying that we should do a gold-backed treasury, because what they want to do is back the treasurers with gold when they're ready to do the CBDCs, reset the gold price, and bring all of that debt down or write off a lot of that debt using the nation's gold and other things like cryptocurrencies and Bitcoin.
Another key aspect of Kientz's analysis centers on the changing nature of demand. He notes that in recent years, a growing number of retail investors and small institutions have been moving away from paper-based products toward physical bullion. This trend, in his eyes, represents a fundamental shift in trust. People no longer want exposure to silver on paper. They want to hold it in their hands. Premiums on physical coins and bars have surged, sometimes far above the official spot price, which Kientz sees as undeniable proof that the paper price no longer tells the truth about what's happening in the real world. He believes that this growing disconnect between physical and paper prices is not a temporary distortion. It's a reflection of a deeper loss of confidence in financial intermediaries and the systems that manage them. Kientz extends his argument beyond market mechanics and into the realm of monetary policy. He connects silver's anomalies to the global debt crisis, rising inflation, and the erosion of fiat currency credibility. As central banks continue to expand money supply and governments accumulate more debt, traditional forms of wealth storage become increasingly unstable. Silver, he argues, stands out as a tangible store of value that cannot be printed or manipulated by policy. He describes silver as the people's money, a form of wealth preservation accessible to ordinary individuals, unlike gold, which has become more institutionally dominated.
So whether it's a stable coin based on treasuries or a CBDC around the world, it's basically the same system. And it's a digitized asset that's based upon confidence of the government, much like the dollar and treasuries were. And we saw, well, that got us. We're at $38 trillion in debt and declining dollar and declining purchasing power. But by tying the digital ID to the CBDCs, now they can control what you spend money on. So go to China, for example, with their social credit system. If you don't do what China wants, they shut off your ability to jump on the train, get a job. And specifically with the digital IDs, it was very sort of under the radar how they popped these out. Over the summer, 17 countries around the world, and that number's now up to 27 in my research yesterday. So now 27 countries around the world in the last 4 months have implemented digital IDs. A couple of really nasty examples are Vietnam, where if you don't have a digital ID on your phone, you can't get a job and you can't use your bank account. And that is law as of right now in Vietnam. In Mexico, they're requiring every citizen to put their biometrics, give the biometrics to the government when you get your driver's license or file any sort of paperwork. The process there is when you interact with government, the Mexican government suddenly becomes super efficient and they collect that data from you very quickly. And now they're expected to implement controls about what you can do if you don't have a digital ID as well. Australia is using AI to capture information on people, biometrics information on people, and they're expected to implement the system as well. And of course, there are 27 now countries around the world. In the United States, this summer it was 11 states that took the Real ID into its digital form. And as of my research yesterday, there's now 14. So that's roughly, what is that? About a little bit less than a third of the overall amount of states in the union now have digital IDs. So with the onset of CBDCs and stablecoins, it's expected to be completed through most countries in the world about 2028, and the digital IDs were just supposed to be completed between 27 and 28. You now have a system that ties your biometrics to everything that you use, and I'm expecting them to get rid of cash as the world de-dollarizes, and you'll be in a completely digital system. A couple of risks there. If you're in a completely digital system, you can't transact privately, and if the government wants to bail you in using the money in your bank account, they can do that according to Dodd-Frank and other laws that have been passed, because you don't own your bank account, you don't own your brokerage account. And if they take it further and we start tokenizing everything and the government decides, well, you've tokenized your car, we've tokenized your car, your house deed, we've tokenized all the assets in the ground for all the resources, and we just simply want to pass a law that now they're ours. They just have to push that button, and now all the ownership then moves to the various governments around the world. And that's not really conspiracy theory, because the WEF has been coming out and saying you'll own nothing and you'll be happy. And a lot of the nation states are agreeing to this around the world, that type of policy around the world. And this is being enacted through these supranational agencies that supersede each nation state's either constitution or their governmental framework into things like the IMF, the BIS, and these other agencies as well. And so we're really marching toward a system in which you're going to have not really a one world currency, but you're going to have a set of regional currencies that are digitally controlled, digitally issued, in which you, at the end of the day, you don't really own anything. And if you don't do, what that could lead to is a tyrannical system where if you don't do what they want you to do, then they can basically turn things off or take things from you. For example, if they've tokenized your mortgage and they've frozen your bank account and you can't work, eventually they're going to confiscate, your home, and then where are you going to live? Those are the types of things that have been talked about in those circles for a long time. There are tons of policy papers written on it, and not making this up. This is literally what they want to do. And it's under the guise of controlling recessions and crashes and that type of thing. And it's a really potentially dangerous system, and it's being implemented very, very, very quickly. So people need to be aware of what's going on. Yeah, the first thing is to get into real hard money, which is gold and silver. It's nature's money. The second thing to do is you want to go to your state house and fight it. I spent the last year or year and a half with Citizens for Sound Money passing gold legal tender laws and also educating legislators on what's going on. The funny thing is, when I was in Florida, for example, none of them really knew about real IDs. They kind of started to learn about CBDCs, but the legislators didn't know about real IDs and things like that. So even your legislators that are making laws aren't fully aware of this system. Again, it's being put into place above the federal level, and it's being brought down to the states and the people. And that's the reverse of what our Constitution says. Our Constitution, the Bill of Rights, Amendment 10, says all the rights not specifically granted in the Constitution fall to the states and the people. So what we want to do as the people, work within our states, which are our partners, to reclaim those rights and to assert those rights. So really, if you're watching this show, it's great that you're watching the show and educating yourself, but you have to get out of your seat and go down to your state house in person and tell your state representatives that you don't want this system, so that the states can begin fighting back. Because right now we still have a federalist system in which the people hold incredible amounts of control and incredible amounts of individual power and sovereignty. But we're quickly losing that because the people aren't really paying attention as a whole to what's going on. Certainly doesn't apply to people on your channel, but it does apply to the majority of people. And so what we don't need 100% of people to do this. We need 3 to 5%. If you look at the revolution, there's about 3% of people fighting for the freedom of the other 97%. So it doesn't need to be everybody. It just needs to be a consistent vocal minority that goes to the state houses and says, this is not what we want.
In the long term, Kientz projects that silver will regain its historic position as a monetary standard in a world searching for stability. As digital currencies and central bank systems expand, people will increasingly seek tangible assets that can't be programmed or controlled. In this shift, silver could become the people's reserve, a decentralized form of wealth protection accessible to ordinary citizens. He foresees individuals, communities, and even smaller nations returning to silver as a medium of exchange and trust, particularly in times of inflation or geopolitical uncertainty. This renewed recognition of silver's intrinsic worth could spark what he calls a monetary renaissance, where precious metals quietly underpin a new global order founded on tangible value rather than debt and speculation. Let us know what you think in the comments, and if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution.